Well, good afternoon and welcome to our HighRock weekly client webinar. And if you do want to skip over our standard introduction or any other part of this webcast, feel free to use that fast forward control that you have on your screen. Otherwise, sit back and enjoy. Now, each week on this call, we talk about what we see developing in the global economy and financial markets and the world of wealth management, how all of this impacts our decisions on the best courses of action for our and your investment strategies. We are going to try a bit of a different format today, and we'd love to get your feedback on what you think of it. As you likely know, if you're a regular listener, we invest our money in the exact same models as our clients, and this is very significant and defines why our prudent and disciplined investing strategy binds us with you. All of our investing interests are aligned. Our discretionary portfolio management not only ensures our legal fiduciary responsibility to you, but also enables us to make quick decisions and execute them immediately for all of us simultaneously. In tricky and volatile markets, this is crucial, and we take advantage of the opportunities that avail themselves to us. I am Scott Tomlinson, and joining us on the call today is my partner and colleague, Paul Tepsich, the founder of HighRock. Our certified financial planning professional and wealth forecast specialist, Bianca Tomlinson, has taken a short leave following the birth of her first child. She does remain on call to us for her expert advice should we need it for you. Well, each week we record this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener who would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this. And all you need to do is visit the homepage on our website and click on the Introduction to HighRock Private Client button. And while you're at it, you may be interested in our voluntary code of conduct as well, something that takes us well above the regulatory requirements in many ways and highlights how we always put our clients' interests before our own. And talking about that, if you have a look at the June edition of the Small Investors Protection Association monthly newsletter, HighRock was singled out and recognized for our leadership role in the investment industry as a new breed where fiduciary responsibility and the client interests are our first priority. I think this is really important of the conversation about wealth management today. And Paul, any thoughts that you might want to add?
Well, I'm thrilled they picked it up, and we've been recognized for what we're doing. And I highly encourage everybody to read the article and then click on our link and go through it in more detail. But, there are probably four key things that differentiate HighRock's private client business compared to certainly in the investment advisor channel and in fact, many other private client firms. And number one is our interests are totally aligned. So Scott and I are trading our own household portfolios exactly the same as our clients. So that's a fact. We have complete fee transparency, and we go above and beyond the regulatory requirement for that disclosure. We have expertise in capital markets, not as investment advisors, but as institutional traders who manage billions of dollars. And there's a significant difference there, I think. And then we're the only portfolio management company in the country managing money on a separately managed account basis, which we do in our private client division, that hasn't formed an independent review committee or an IRC. And that IRC reports to our clients every quarter to ensure we're effectively doing what we said we're going to do. And those are key differences that I think SEPA has picked up on.
And not only that, but the interesting thing about the structure of our company is that we don't have, like banks would, have shareholders to answer to. We don't have any revenue targets to meet. We don't have, but as you said, we do have our own money invested in the exact same assets as our clients. So we do for you what we want to do for ourselves. So we want to grow our money, but we're always managing the risk first. Now, we may not always perform with the stock markets all the time, especially if we deem that there is too much risk inherent in doing so. And I think that brings up another key point to how we look after our clients, Paul. And let's talk about some of that responsibility. Let's talk about how we grow our clients' money, our own money as well, in the context of taking risk. We've had a number of conversations with clients recently who have raised some concerns with the lack of growth over the last few months. So let's talk about that just for a bit.
Well, we're not managing client money or our own money month to month. We're doing this, we're mid-50s. We're doing this for the next 30 years, not the next 3 months or even 3 quarters. We're doing it for the next 30 years. So effectively, and you show this chart pretty well every week, but I won't go through it in detail, but we do say this periodically and in some of our print, but we manage risk. That's what we manage. We don't manage to a return. It's impossible. We can't say, well, we're going to try and get a 7% return or 5% return. What we want to do is manage risk. We always want to take care of the downside. But as this table in the top part shows, really, when you talk about returns, you need to talk about how much risk did you take to get those returns. That is the key. So in the orange part, you can see the return per unit of risk, which is effectively a bastardized way of showing a Sharpe ratio. But that's the key. How much risk did you take to get those returns? As you can see in the S&P, for the past 40 years, it returned 13.15% return annualized. But it took 5.8 times standard deviation. So your returns could have deviated a fair bit. And they did deviate a fair bit. So you took a lot of risk or volatility to get those returns. You can see the HIROC client portfolio had almost half the volatility of the S&P. That is the key.
And just even looking further, and in that chart that we just talked about, this particular client, and you can look and see not every month. And sometimes there's a couple of consecutive months where there's some downside. And as you said, we're not always going to have consecutively positive months, but there are lots of things that we work on a regular basis that give us the ability to have some pretty good months when we do get it right. But it's not going to happen necessarily month to month to month. And as you can see, the averages over longer periods of time tend to hold up, whereas averages over shorter periods of time can be a little bit more volatile, a lot less volatile than the S&P 500, mind you, right?
And what we want to always do is remove as much volatility or risk as we can and still try to meet our returns, our objectives.
Now, this particular portfolio that we're looking at is a standard 50% global equity, 40% fixed income, 10% tactical. If we look at a portfolio that is actually a little bit of a different structure, and again, depending on our wealth forecast for you, our clients, we may have a different objective. We may have a different structure for your portfolio, depending on what your goals are. In this particular case, you can see that from the get-go in this portfolio, it was a little slow going. There wasn't a lot of great opportunities, and because it's more weighted towards the tactical side, there wasn't a lot of great opportunities in the beginning. However, Paul, and I'll let you talk about this a little bit more, but as we got into 2016, the beginning of 2016, opportunities presented themselves. We took advantage of those, and this particular portfolio had a really strong year. And when it averages out, you can see in time it will grow to be a fairly good producing portfolio. But this is something that happens over longer periods of time.
I would add to that too, Scott, and just say this particular portfolio looks like it started March 2015. So some of that negative performance is also just, once a new client comes on board, quite frankly, usually what we have to do is sell all their equity mutual funds, and there's a cost to that quite often in these deferred sales charges or any other fees that the mutual fund company may charge. So sometimes there's negative performance because of that. But also when we're investing up, there's sometimes a little bit of negative performance because we have to go out and try and build that client's now cash into our models. And if we have to pay the offer side on certain stocks and bonds to get them invested. Then they get marked. It's kind of complicated, but we're paying the offer side and it gets marked every night on the bid side. So you lose a little bit of friction just by investing up into the models. So that may have happened, but otherwise, yeah, that, there are pretty good months in 2015, and I could respond to what those are, certainly starting in March, not 2015, 2016, pardon me. March, January and February were very tough months in certainly the Canadian stock market. This is when oil was hitting high 20s, $27 a barrel. And we were in pretty good shape with over 30% cash. But what we did do was we went out and bought some high yield energy bonds in the tactical model. So this client had 25% in tactical. So whereas the client on the previous slide only had 10%. But we had about 5 of these high yield energy bonds that were quite impactful. One of them was more than a double. And actually we still own it. It was a really good trade, but we had other ones in there that worked out really well. And that was largely part of the performance in 2016. Today, those trades or those types of opportunities are not staring me in the face. So we are being a little more cautious with our opportunities here. And again, as you said many times, Scott, trying to manage the risk. And quite frankly, the only other thing to add, one more thing is that I wrote a blog on this. The TSX is the only G20 nation that is down year to date, the Canadian stock market. And it's down 1% as of today, year to date. So even this client is up 1% year to date. Now, it's not fully invested in stocks or TSX stocks, but you know what? It's a slow year in Canada. That is for sure.
And it is why we do also have exposure to global equities to be able to get some other returns into a portfolio. But it is a very difficult time for investing from that perspective as well, because a lot of global equities at this particular point in time, we consider them to be at a very high level of risk. And we can look and we know that when markets are making their peaks, that is a point of high financial risk in certainly in equity markets, in any market for that matter. And we're very cautious about adding to anybody's portfolio if prices are just that high that they pose too much risk. So newer clients, unfortunately, without opportunities in the tactical side, there's not a lot of opportunities yet on the equity side, and it's difficult from the bond side even because of the volatility there. So it is a function of trying to make sure that we pick the right spots, and there will be times where there isn't a lot of monthly growth, and then there will be times as we get opportunities and we are able to take advantage of them that there will be also some good growth. But as we constantly say, we're managing the downside. We're making sure that your principal is being protected at all times, and that's our focus.
Yeah, until we get a clear view on some great opportunities.
Absolutely. All right, thanks, Paul. As we usually do, we talk a little bit about our key themes, and they haven't changed. Avoiding risk, as we just said. When risk is high means being more tactical inside an investment portfolio. Price stability, important, is a mandate for all central banks, and the level of inflation or expected inflation is a key determinant for the central bank's policies. The Bank of Canada raised rates last week. The Bank of England and the European Central Bank have dropped hints that they're reviewing their current easier monetary policy stances, and they're perhaps getting ready to begin the process of reversing it. And as we know, the U.S. Federal Reserve has raised rates by 0.75% since December, and it is expected that they may raise them 1 or 2 more times this year. Well, rising borrowing costs and reduced financial system liquidity, which had been driving equity and housing markets higher, may certainly increase volatility going forward. And we'll talk about what's going on in the Toronto market, housing market, in a few minutes. Stock prices and valuations are at close to their highs. We continue to mention that, but without more significant earnings growth, it does leave them vulnerable to a correction, and economic growth does not appear to be supporting current valuations. The Trump agenda has failed to bring about a new healthcare option. We have Brexit negotiations ongoing. NAFTA is just undergoing its renegotiation. And there's the geopolitical tensions with North Korea, Russia, Middle East, as well as the global cyber attacks, terrorist threats, and all of it adding to the blend of political uncertainty that is out there right now. Well, historically, strong economic growth tends to push stock market prices higher, and at the same time, bond prices fall as interest rates move higher. Now, when economic growth stalls, stock prices tend to fall and bond prices rise. And this is a correlation that historically is the rationale behind a balanced portfolio. One of the things we've noticed more recently is that these correlations are in a bit of a state of flux as markets try to determine what will happen next amid all of the current uncertainty, and the correlations are not necessarily providing the same level of protection that they usually do. And Paul, you may want to just sort of talk about this, but both in the US and in Canada, and very specifically, we can talk about what we've seen recently in the spike in bond yields.
Well, we had, they actually rallied pretty substantially today. And if you go back to the previous chart, Scott, perhaps, if you can.
Yeah, absolutely.
The US, there you are, the US bond stock correlation. The bonds are obviously in yellow. And you can see that they've rallied, rates going down, that is, so prices going up. We would call that rates are rallying. Well, yet the white S&P stocks are moving higher, so they are diverging. In the bottom part of the chart, you can see how it's gone. The green has gone to red, which means the traditional hedge that we would get from government bonds is separating. And probably not providing the hedge that you would normally like. So this is a diverging pattern, and something we need to keep an eye on. Canada, not quite as much. Maybe go to the next chart again, Scott. You can see the Canadian correlation in the bottom part is still green, and Canadian bonds have been hit very hard, as we've talked about the last couple of weeks. Certainly Bank of Canada comments, and then the effect of a 25 basis point increase in the overnight lending rate. Now, this chart was taken this morning reasonably early, but rates have rallied almost 4 basis points today, during most of it coming in the afternoon. So that green line on the top part is actually ticking lower, i.e. Yields going lower, prices going higher. So it too is going to start looking like correlation is falling apart.
And to some degree, that's a function of the fact that the Bank of Canada raising rates is tightening monetary policy. And in fact, it is an inflation fighting tool to do so. And the fact that they're fighting inflation that barely exists is somewhat suspect, I think. And I think that's why you may see a little bit more volatility in the bond market, as the bond market does try to figure out all of these all the things that are going on.
No, the bond market today, certainly in the U.S. 10-year treasuries have rallied 5 basis points on the day.
Yep.
So that's a pretty substantial move. I think even in Canada, what the longer term part of the bond market, the 10-year and the 30-year part, is telling us that A, inflation doesn't exist, and B, the central banks hiking up rates prematurely could be making a policy error. So most of our bond risk is in the 10-year and the 30-year part of the curve, which is the part that should perform better.
Excellent. Thank you for that input. And having a more tactical approach, as we say, because it is our philosophy here, allows us to depend on those less reliable old correlations. And as we've seen, those correlations are in a state of flux. So, and when they do not appear to be providing the appropriate balance, people who have those traditional balanced portfolios are likely to feel it with significantly more volatility, perhaps. And of course, we remind everyone listening that historical returns are no guarantee of future returns, but at High Rock, we always do work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is very important that we review your wealth forecast on a regular basis with you so that we can ensure that your long-term goals are still in line with your portfolio strategy and that our forecasts for your net worth into the future are up to date and heading in the right direction. If you'd like to review any aspect of your portfolio wealth forecast, please do not hesitate to reach out to us. Okay, well, we talked a little bit about the evolving inflation story already. It is one of our key themes for 2017, as I mentioned earlier, and we literally try to assess what the implications are for central bank monetary policy and interest rates. If economies are growing, inflation should be growing, but this does not necessarily appear to be the case. Well, the Bank of Canada, as we said, raised interest rates by 0.25% last week, and they stated that it was in the context of an economy that is approaching full capacity and with inflation expected to reach the 2% target within the next year. But as we've discussed, current inflation remains well below the 2% target, and higher interest rates may impose further slowing of economic growth and lead to even potentially lower inflation. Remember, the Bank of Canada economic forecasting has, over the last few years, been less than accurate, mostly erring towards the positive economic outcomes. Well, on Thursday, we'll also hear more from the European Central Bank on their interest rate policy. And as we discussed last week a little bit, Paul, it appears that central bankers are universal in their thinking at this particular point in time because they're all somewhat a little bit more hawkish.
I think monetary policy has done its thing the last 7-8 years. It was not as effective as they were hoping with regards to increasing economic activity and inflation around the globe. And I think what they're trying to do is avoid asset class bubbles, number one, and number two, force politicians to enter into more fiscal policy. But that's where the rock and the hard place comes, because there's so much structural debt around the world, i.e. government debt, that various levels of government cannot afford to put forth fiscal policy. So it's a hard place to be.
Yep. And case in point is what's going on in the U.S. Situation, and we'll get to that in a couple of minutes. Today's UK inflation data showed a drop inflation. They'd been running a higher level of inflation because of the drop in the pound since Brexit. And of course, the latest US CPI data has declined even further. And of course, as we mention each week, from the beginning of May, where US second quarter GDP was expected to come in somewhere in the 3.5% to 4% range, has now been reduced to somewhere between 2 and 2.5%. So there's certainly something to be concerned about from a growth perspective. And the most recent retail sales data last week was certainly lower than expected along the way. Then we talk each week about the flattening yield curve and how historically that flattening yield curve has been impactful in producing recessions, and we're keeping an eye on what's going on there. So that 2-year to 30-year yield spread that we talk about in the U.S. is now about 1.5%. So still a ways to go before it becomes recessionary, but we keep an eye on it, and it's come down certainly a fairly significant way from earlier or late in 2016 post Trump election. In Canada, we're down to closer to 1% from a wide of near 1.7%. So again, yield curve flattening, and the flatter the yield curve, of course, the closer we get to recession. As Paul mentioned, we are paying close attention to the global debt situation, and as interest rates rise, borrowers' ability to service that debt becomes more of an issue. Interestingly, in 2009, $2.5 billion of new subprime auto bonds were sold. And remember subprime mortgages and what happened there. Well, in 2016, there was 26 billion in subprime auto loans that were sold, and that topped the average pre-crisis levels. And defaults are now surging significantly, something to keep an eye on in the U.S. situation. And then, as I mentioned before, prior to the interest rate hike in Canada, Toronto housing prices were already in decline. Paul, I know you have some issues with some of the headlines, but it does remain to see what higher rates are how they're gonna impact this market as well, I would imagine.
It's not going to be good. It's not going to help. And I can't remember the actual number, Scott. I think I wrote it in that series of blogs I wrote a couple weeks ago about the City of Toronto housing market. But it's something like 23% of the Canadian economy is related to housing. And with the consumer, running personal debt to disposable income somewhere up in the 160, 170% area, and the housing market coming off, and mortgage rates going up, although some of them aren't actually going up, some are. It's not a good recipe for the overall Canadian economy.
Yeah. So again, wondering what the Bank of Canada is actually trying to accomplish, but obviously they're trying to take the zest off the top of the housing market, and that seems to already be happening.
Yeah, they didn't need to raise rates to do that.
We talk about how we think equities are expensive. That's not a new theme for us, so I'll pass through that fairly quickly and a couple of the metrics that we look at, but we still think there's a lot of froth, especially in the U.S. Equity market. Let's just look quickly at the geopolitical front. The Trump administration has been struggling to move its agenda forward, and today Senate Republican leaders gave up their effort to dismantle and simultaneously replace much of the Affordable Care Act, known as Obamacare, and even desiring to repeal Obamacare now doesn't seem to be something that's going to work. So there's all sorts of concerns there at this particular point in time, and at the same time, House Republicans are unveiling an ambitious fiscal plan that would let them try to rewrite the tax code and revamp medical malpractice laws, change federal employees' retirement benefits, etc., and all in one single law without any voting from the Democrats. And this strategy, embedded in the House fiscal 2018 budget, faces a huge amount of political and procedural obstacles, including many of the same ones that derailed the health care bill. So it looks like things are stuck as far as the U.S. administration is concerned, and all their hopes for getting a lot of this stuff moved forward seems to be grinding to a halt, and that may have some impact as we go forward. And of course, the Trump administration released its roadmap for remaking the North American Free Trade Agreement that aims to preserve their Buy America provisions and reduce the U.S. trade deficit with Canada and Mexico. But it does apparently step back from some of President Donald Trump's most fiery campaign rhetoric on trade. So again, we'll see how that evolves as well. And while we're doing that, we're going to be cautious here at High Rock. We're desiring portfolio growth, but at the same time, we are certainly uncomfortable with equity market risk at this juncture. The U.S. economic cycle late in its stages, and there are signs that make us uncomfortable with having too much risk in our models and portfolios. So we'll pick our spots carefully, as Paul mentioned. We've all worked too hard for our money, and we want to make sure that we invest it prudently. Well, that's it for today, and as always, we want to thank you for taking the time out of your busy schedules to tune in. If you have any questions or concerns, any feedback at all about our revised format, we would love you to email them to us. Let us know how you feel, if there's anything that you want us to cover. We will be back with our next update next Tuesday, but until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, we want to wish you all a great rest of the week.